let's move on to the fourth session, The Road to Sustainable Investing, a Journey for Insurers. This presentation will be given by Clara Yan. Clara is the head of insurance analytics at Robeco, where she develops and coordinates Robeco's insurance analytics capabilities and advises insurance clients on asset allocation, capital management, accounting, regulatory, and asset liability modeling. Clara joins from Schroders, where she served as insurance asset liability management director, responsible for balance sheet advisory, investment strategy, and portfolio advisory work globally. Prior to that, she worked at UBS and Legal & General Investment Management. Clara is a fellow of the Institute of Actuaries and a CFA charter holder. She holds a Master of Science, Financial Mathematics from Cass Business School in London. Now over to you, Clara.
Thank you. Hello to everybody. Very pleased to be here to be sharing my thoughts on the topic of sustainability, impact investing. I guess maybe a pretty, thank you for introduction, but maybe it's worth talking about you know, what I'm currently doing and why I'm talking about this topic today. So, I mean, from Jessica's introduction, you've seen that previously in my career, I have spent a lot of time looking at building essentially asset liability modeling solutions for insurers via various asset manager banks and insurers. But more recently, I mean, as you have heard elsewhere, there's definitely a significant trend towards integrating ESG consideration into the insurance investment solution. And I really joined Robeco in wanting to being able to work further on integrating this rather challenging and complex topic and looking at how best we can provide an ESG integrated investment solutions for insurers. So to kick off, what I thought would be useful is really just talk about the basics of sustainable investing. No doubt you probably have heard a lot about it in the media, and it's been, you know, one of those topics that are, I would say, can be quite subjective. There is no single right way of describing what's potentially ethical and sustainable, and I think there are a lot of different definitions out there. So usually I find it's useful to kick off by talking about what we see as the our definition on this. It's also worth mentioning that sustainability investing is obviously gaining in popularity. So far there's already $30 trillion worth of assets being managed globally under sustainable investment principle. And we can clearly see that there are definitely more of the investment interest going into that. I think the best way of thinking about sustainable investing is actually going back to the United Nations principle of looking at responsible investment. So their definition is really thinking about it as an investment approach. It is an approach, it is a philosophy, looking at incorporating three main areas: environmental, social, and governance factor into the investment decision, with the interest of managing better long-term risk and generate sustainable long-term return. So when you think about it, sustainable investing isn't about what you can do in the short term. It is a long-term risk and return management process. So that covers what sustainable investing definition could look like under the UNPRI definition. But what I thought may also be useful is to talk about briefly some very broad categories of ways of different investors are achieving sustainable investing. So if I start off with the bottom left-hand corner, I think usually when people think about sustainable investing, they start off by thinking about exclusions. And what are the ethical, controversial business practices that you want to exclude from your portfolio. Very often they will be excluding things like the sin stock, the areas where you are investing in the tobacco company, the gambling company, alcohol, etc. And it is a very simple, easy, quick way of avoiding controversy. But what it doesn't do is actually looking at the ESG factors in your non-sin companies. I mean, what is Tesco doing on their ESG integration? What is Vodafone doing on their side? I mean, all of the company these days have integration with ESG. They are influenced by ESG. They will have to consider ESG in their business practice. So a lot of times, I think starting off with exclusion, majority, I think, of the investment processes more or less evolve and move on to what we call ESG integration. So with ESG integration, your asset manager essentially is saying that, you know, we have to do our research, we have to analyze the companies, we have to think about their business practice, the corporate profile, the long-term, assess their long-term risk and return. But while we are doing that, we will also look at ESG information, think about ESG in looking at those assessments. So ESG essentially is an other factor that they take into consideration in their normal standard investment process. And with that, they use the ESG consideration to predict whether a company could be at risk of environmental issues going forward. For example, high carbon emission leading to regulation which cause penalty to the company. They also look at ESG as a way of identifying opportunities. For example, looking at renewable energy. Given the high carbon emission, there is far more interest in generating renewable energy, and that could be a potential opportunity from an investment perspective. But even at that point, integration is very much still a financial viewpoint. You are using ESG to decide whether it will make sense financially to buy the company. So moving on from integration, and this is the area that I'll be talking about today, is really focusing more on impact investing. So ESG integration looks at what ESG factor means from a financial perspective. It is somewhat objective. You still have a strong investment focus behind it, but you may consider investing in companies that may have a negative social impact if you think the valuation perhaps justify it. So it is a little bit more encompassing. And impact investment really focus more on positive social, economic and environmental return. And what you aim to do under impact investing is avoid companies that are causing negative social impacts, and overall your portfolio would aim to generate a positive impact coming out of this. So if you think about it, looking at impact investing, I think some of the three areas that you need to think about is, one, is it intentional? So you will construct your portfolio to make a deliberate, targeted effort to make a positive contribution, and avoid companies that are potentially generating a negative contribution. Just because you're looking at impact investing doesn't mean you forget about profitability. At the end of the day, on top of focusing on a positive impact investing, asset managers will still have to consider a financial return. So profitability is one of the measures that you need to take into account. And thirdly, on top of saying that you will be able to generate positive impact, one of the key criteria of doing impact investing is measurement. Can you measure it? How do you demonstrate that you are generating a positive impact? How do you avoid greenwashing along the way, claiming that you generate impact based on a set of figures? How do you prove that you're and have evidence it? And that's a big part of the consideration when you are looking at impact investing. So what I thought I would do now is to go through, just touch on some areas how insurers are thinking about sustainability, because I think that's quite a broad topic at the moment, extremely topical amongst the market, and maybe worthwhile just to think through how insurers are thinking about it. And I think it's almost impossible to talk about sustainability without touching on climate. So obviously, there's a huge amount of press, information, corporate announcement on insurers putting into their corporate policy their target for committing to generating net zero carbon emission, usually by 2050, although some of the insurers such as Swiss Re have committed to a more aggressive target of achieving net zero carbon emission by 2030. A lot of them have already joined what we call a UN Net Zero Asset Alliance, where the institutional investors, such as insurance and pension funds, are committed to delivering zero carbon emission portfolio by 2050. And I think, it's fair to say this covers a very large part of the market. I think at last count, the asset under management that is included in the Net Zero Asset Alliance is standing at about $6 trillion. So even if you don't necessarily believe in climate change and you're not necessarily committed to it, just by looking at the sheer size of the commitment from the institutional investor, it's fair to say that this will have an impact on the market, and everyone else will need to consider that when they're looking at their own investment policy. And I think every day, you can see that the new corporate announcement coming through about more insurers committing to some form of zero carbon policy. They don't always necessarily join the Net Zero Asset Alliance, but they certainly have integrated that into their corporate policy. So that covers climate. I think the other area that we talked about a lot with insurers is really thinking about how do you define impact investing. It's not the most obvious thing to define. Impact can cover a lot of different social, environmental factors. So what we see in the market is typically insurers will tend to follow the UN Sustainable Development Framework, which is a framework that defines 17 objectives for improving really the human society, sustainability and quality of life by the United Nations in 2015. The aim is to be able to achieve this by 2030. And I think, if you go into the website, there's some excellent videos on showing how this could be achieved and how really over 190 countries in the world have signed up to this initiative. But what we provide is actually quite conveniently a framework for defining what kind of impact you want to achieve. And as you can see on this table, we have highlighted quite a number of major insurers who have committed to different parts of the sustainable development goals. Some areas to highlight, I think obviously climate is a big part of the sustainable development goals, and almost basically every single insurers have said they will commit to climate change. But if you look around at the different SDG goals, you can see there's quite a lot of variation really between different insurers. Not everyone is committing to the same set of objectives. And they will have different focus when it comes to running their investment policy based on the sustainable development objectives that they have committed to. So here, what I thought might be useful is to show you an example of how an insurance company may articulate some of their sustainable ESG impact objectives. This example we have taken from a Japanese insurance company, Nippon Life, but most of the insurers that typically have very similar type of style when it comes to thinking about how they define their policy. Firstly, I think if you look at the top left-hand corner, there's generally a commitment from the insurer to invest a certain amount into sustainable investment assets. Commitments generally is quite high, and they tend to ramp up over time. I think in this case, it is a Nippon Life has committed to investing 1.5 trillion yen by 2023, which is not really that far off from now. In addition, I think, again, Nippon Life themselves have committed to sustainable development goals. So their objectives are looking at no poverty, good health and well-being, reduce inequality, sustainable cities and communities, and climate change. And on the climate objectives, there is definitely a commitment to looking at typically reducing carbon emission, I think in this case, by 40% by 2030. And again, you know, going into in line with most other institutional investors in the market, targeting net zero by 2050. So this gives you kind of an overall idea of what the broad picture looks like at the corporate level. And of course, I think it would be difficult to talk about how insurers think about sustainability and impact investing and climate change without considering some of the regulatory requirements that are coming through. So I thought it may be useful to touch on some of these regulatory requirements. Very much at the moment, European and UK focus, although we can see in the US with Joe Biden signing up on the Paris Aligned Agreement in the US, as well as in Asia, where there's a lot of interest in looking at EU regulation. This is definitely going global, and it will have a very wide impact across, I think, all the major insurance regulators around the world. Some of the areas I think that is worth touching on in terms of regulations, one is really looking at sustainability labeling. So you have already worked on developing a sustainability label standard called SFDR, which help essentially investors to, well, it classifies the funds into different sustainability classification, and if for an asset manager to be able to claim that they are providing a sustainable fund, they would need to be able to evidence it, and SFDR is part of that framework that helps to regulate the labeling of sustainable fund and be able to help investors to avoid greenwashing. In France, they have gone a little bit further. Insurance companies are actually forced to offer at least one socially responsible investing products as part of their pension offering. On the risk management side, you have, again, quite a number of regulation, mostly in consultation, some of them in progress. So on the risk management side, EIOPA have already issued an also consultation paper on climate change, outlining the expectation for insurers to integrate climate risk into their own internal risk assessment. That's quite extensive, and I expect that a lot of insurers will have to spend a lot of time working out how they can best manage it. And the PRA has also gone through and issued a number of PRA stress tests. Again, this is really there to help insurers to run scenarios testing to see potentially what kind of climate change risk impact they could have on their portfolio. On top of that, I think there's a lot of focus also on disclosure. So on the UK side, PRA Bank of England has already asked that the TCFD disclosure be made mandatory for insurers, banks, and the large occupational pension scheme by next year. So it is the idea that if you are disclosing what you're doing on climate, you get more focus and attention on it, and therefore you'll be required to make fairly sensible and evidence decision behind it. In France, they have already issued what they call an Article 173 a few years ago, where insurers, again, will have to comply or explain and disclose their climate change risk policy on the portfolio. And we've seen that via that particular disclosure requirement, that has already forced a lot of French insurers to change the products they offer to the market, really to make sure they are more compliant with the sustainable risk explanation they have, and that ultimately forced them to disinvest from some of the non-ESG funds and portfolios. So looking at regulation and climate change in a little bit more detail, I think PRA has definitely done a lot of work on this, specifically for UK insurers. And I thought it may be useful to summarize some of their viewpoints via the DEOC letter that was issued towards the end of last year. I think the reason why I chose this is I think out of all the regulations I've seen so far, theirs is probably one of the clearest one in terms of stating what's needed to be done from an insurance perspective. Firstly, I think there's a very clear focus from the PRA on governance. So you need to have a senior management function responsible for identifying and managing climate risk change. And this is a person that needs to be able to report into the board level. From some of the initial responses that PRA have seen so far, they think, yes, you have somebody that has been identified and appointed to be in charge, but there should be more discussion and communication happening at the board level. So they do expect your board members to be understanding all the issues behind it and be able to manage it at that level. And then we think that generally means require more education across the industry. From a risk management perspective, again, there's a recognition that data assumptions are difficult to come by. Louise have already mentioned this before. This is a new topic for everybody in the market, but still, you know, there still needs to be a need to build out a risk management framework behind this. So that you know, in line with your typical insurance risk management process, there is a huge focus on understanding data, understanding the limitations, and building the tools against it to be able to monitor and manage it going forward. I've touched on this before, scenario analysis. This is coming up quite regularly across all the regulatory discussions. Every regulator has a slightly different set of scenarios, so you know it's quite interesting to see what's been put through. But this is essentially a way of helping insurers to find ways of assessing how their business could be impacted by climate change, and that's really a measurement issue. Disclosure I have already touched on. I think as part of disclosure, on top of being able to show the carbon emission and the climate change policy that you have within your company, I think one of the key things that insurers need to think about is really interpretation and communication. There is no, at the moment, completely standardized way of communicating carbon footprint change. It is very much open to interpretation and assumptions that you put through. So I see that potentially as another area that insurers would need to work on quite heavily in integrating the climate change. On top of all this, I mean, this is just the risk and governance framework that insurers have to go through. All these need to be linked back to your investment decisions and policies. So your standard investment conversation about risk, return, asset liability matching, capital management, volatility adjustment, matching adjustment, all these kind of solutions work need to be integrated back to your sustainability and climate change policy. And we see that potentially it will be a continuing evolving area that requires a lot of work, but we're quite interesting to see what comes out of it with all these new considerations. So going through this, I think next thing I just want to outline is potentially how impact investing can help. Looking at this, I think in terms of investment strategy, you are looking at, this is quite simplistic, but one way of thinking about it is you can think about impact investing in potentially 3 areas, with touching on 3 different purposes behind how an insurance company may run their books. So to start off with, if you think about thematics investing is really thinking about investing in themes that contributes to development of sustainability. So potentially you're thinking about investing in specific themes like water, renewable energy, and really your aim is to demonstrate that you are providing a positive impact, but on a very specific sector or area or topic. This is an area that we think works pretty well for unit-linked policyholders. So a lot of the policyholders we see, particularly in Europe, on top of wanting to choose the right investment policy or pensions, retirement savings tool for themselves in the long run, that there is an increasing interest in really investing in something socially responsible at the same time. And we think that being able to demonstrate that you can offer thematic policy that ties in with a socially responsible objective fits well with what the retail clients are looking for in the market. If you think about the second way of think about impact investing, another way of thinking about it is really how do you develop a investment portfolio that fits in with the insurance company SDG framework, their own sustainability goals. This is slightly broader because your sustainable development goals can cover quite a wide range of objectives, but it is possible to construct portfolio solutions that meet the insurers' sustainable development goals target, and I'll touch on that a little bit later. And thirdly, you can think of climate as a theme. I think I do think of it as a theme, but realistically, I think there has been so much attention and focus being made on climate change. It's almost easier to identify it as a separate area altogether. With climate investing, part of it, as I touched on before, is very much about focusing on meeting a net zero carbon emission target at some time in the future, be it 2030, 40 or 50. The aim of doing that is really be able to help the world reduce the temperature rise to well below 2 degrees in the long run. And I think, a climate specific kind of investment policy really helps insurers looking to meet their decarbonisation target. So I thought it may be useful just to go through a couple of examples of what it looks like in practice. This is fairly brief, and if you have more questions, do feel free to reach out to me and I'm happy to explain it further. So on the thematic side, I think one way of looking at this is potentially looking at investing in a sustainable water fund, which is targeting at producing clean water and dealing with water wastage. So in terms of thematics, obviously, it also feeds into the specific sustainable development goal of providing clean water and sanitation, and via the treatment of water wastage being tackled of helping marine life development in the SDG 14 goal. But what's useful, I think, to think about when it comes to looking at things like thematic investing is really what is measuring the impact. It comes back to measurement at the end of the day. How do you communicate to your policyholders what positive impact are you doing with your specific thematic investment strategy? In this instance, we have put together a set of metrics that would illustrate what kind of impact we would achieve by putting in €1 million worth of investment. Obviously, this scale up quite significantly if you think about the size of the investment that an insurance company would make. So for €1 million worth of investment, potentially you are providing 48 billion litres of drinkable water. That works out to be 700 and about equivalent volume water, about 759 average household per year. You are helping people to be supplied with clean water across the world, and to a total of almost 500,000. And you are also helping to treat wastewater in a portfolio to the amount of about 32 billion liters. So what we think is quite interesting about this is all these metrics are very relatable. It's things that I think a lot of retail policyholder can understand and touch on and can relate to, and it's something that helps them not just think about potential return, although that's part of the consideration, but also some of the impact that they can have, but on deciding where they can invest in. Conscious I could be running out of time here, so I'll do the rest pretty quickly. Second one I just want to touch on is the Global Sustainable Development Goal Credit. It is a strategy that has been set up really to only invest in companies that have a positive sustainable development goal impact. And, you know, one of the questions that we get asked quite frequently when it comes to sustainable investment is, how does it impact on performance? Does it mean you have to give up on performance to really achieve all these positive impacts? I think on the table on the right, I'll give you a breakdown on how potentially looking at positive sustainable development contribution can help with our performance. So overall, when you're looking at the Sustainable Development Goal screening, we have generated an additional 87 basis points from it, and a lot of that is generated from the fact that by avoiding negative contributors, we're also avoiding companies that are potentially generating a lower return, and our positive SDG contributors are also generating a higher return. So hopefully that gives you an idea of how incorporating sustainable development goals can positively contribute to investment performance. And here is a very brief set of slides outlining how the portfolio is performing against the benchmark in terms of sustainable development goals. So this is another part of the measurement conversation I discussed before. For all of them, you can see almost all of them that the portfolio has outperformed the benchmark in terms of generating a positive increased sustainable development contribution in constructing this portfolio. Conscious I'm running out of time, so perhaps I think I would stop here. And just to say that if you got interested in sustainable investing, it's worth mentioning that I have co-authored on a paper on this, talking about sustainable investment journey for insurers, and Rebecca herself also had developed a knowledge base that covers insurance solutions, climate investing and sustainability investing. Lots of information there, all in a lot of detail. So if you're interested, I would encourage you to go in and register. And with that, I will stop here.
Great. Thanks, Clara, for sharing your experience on impact investing. This is definitely a new area for us to learn more about. Very inspiring presentation. Thanks again, Clara.